Hey everyone, it's Tom Kratz, and you're out on another morning walk with me here in Oakville, and we're going to tackle a tricky question. This is something we get asked a lot. We don't have a crystal ball on this, obviously, but we're going to give it our best shot. What would a real estate market collapse look like? And ultimately, the real estate market, here, this is all our opinion, obviously. The real estate market is built on credit. So if the credit to build the real estate market disappears, we're likely going to have some type of plateau. If it disappears in a great way, we're going to have a collapse. That's just the way things work. So when they tighten mortgage rules like the way they just did, they're doing that a little bit. They're tightening up the access to credit. So that will likely have some impact. It doesn't feel to us that that's going to have a major impact, but perhaps it will. Time will tell. The next few weeks, next few months will tell. But it doesn't have to come from Canada either. All the banks are connected today. This isn't like 26 years ago in the last Toronto real estate collapse when the banks were a little bit more isolated from each other. Today everything's connected. So for perhaps a bank in Germany, let's say Deutsche Bank ends up having real major problems, and it goes and has some bailout, or it has to wash some of its debt. Perhaps that has an impact to Canadian banks here in Canada. Canadian banks tighten up their lending policies, and that has an impact in our local markets right here. So everything's connected. We don't know where this little spark that could start a collapse could come from. But if it does come, if the access to credit does disappear, it's going to have an impact on the real estate market. And when that happens, it's deflationary, meaning prices are going to drop, and likely, if credit goes away quickly, hard and fast, and people can't access credit, the prices will come down hard and fast. We saw this before in 1990. It was a little bit the opposite, where the market was overheating back then, and it wasn't a disappearance of credit, but the banks increased interest rates rather aggressively in a short period of time, and because they increased interest rates rather aggressively at that point, property prices came down rather aggressively in a short period of time. So it all stems around credit and the access to credit. That's the way the housing market is built. Right or wrong, we can debate all that, but that's how things work. So if that goes, if credit disappears, it's likely going to have a deflationary effect on prices, meaning prices will come down. But here's the thing: we all know that the governments aren't going to let the banking system crumble. So if this happens, they're going to likely have a response to that, and the response might be it used to be, when there was a problem with credit, it used to be that they would cut interest rates. But now that interest rates are pretty much next to zero, most economists believe that they need a 3% cut to stimulate the economy if a crisis happens of some sort, if it's a recession period of some sort. But now that interest rates are so low, they can't cut them 3% without going negative. So what is going to be the policy response to such an event is our question. Because if a crisis does happen, credit goes away, real estate prices come down, the response from the government might be inflationary, meaning they might try to cut interest rates low, they might try to go negative, or they might try and flush the market with cash and do a lot of stimulus. That is likely an inflationary response, and our question to you, for you to consider, is can they control that? Will the same property prices that came down begin to go up because the value of our incomes and our dollars begins to decrease with all the stimulus that they pump into the system? And if that's the case, will people owning good income properties that cash flow and pay for themselves, if they can hang on during the down cycle of a crisis, what will the value of those things be during the policy response? It will likely go up, because the value of the dollars will go down in a stimulative type response by the government. So these are super tricky times. If you're overextended on a piece of property, meaning that it's producing negative cash flow, your rental property, your income properties producing negative cash flow, those are difficult to hold on during deflationary periods. But if you have good cash flowing property, and you can find such things during the down cycle, if you can survive it, you'll likely ride out the policy response quite well. Of course, this is our opinion, and it's part of the reason that we don't flip properties right now. We consider it too dangerous. It's too speculative to flip properties, because if we get caught holding a property over a 6-month or a 1-year project, and there's a deflationary cycle, we might not be able to complete that project or sell it for the profit that we intended. We might be stuck holding a property that we didn't want to hold. So kind of interesting times, different risks for different people, but hopefully that gives you something to think about. Until next time, your life, your terms.